Now, without further delay, let's begin today's event, Exploring Options, Defined Outcomes, and Risk-Return Strategies with ETFs. I'd like to turn the floor over to Morrison Warren, partner and co-chair of the Investment Management Group for Chapman and Cutler LLP. Morrison, the floor is yours.
Thank you very much. Hello, everyone, and welcome to our webinar. We may call what we're talking about defined outcome ETFs, and for general purposes. Our goal here is to help illuminate this exciting area of the Investment Company Act and also in ETFs in particular. Defined outcome ETFs were first brought in 2018 through Innovator, who one of their representatives is here with us today. The area has grown tremendously over the past, I guess at this point, 7 years. There are several hundred funds that are out there and multiple ways to bring these products into and provide multiple exposures. I'm delighted to be joined by 3 experts in the field of defined outcome ETFs. They will share their views, perspectives, and hopefully this is going to be helpful for you all. We will try to cover ultimately a background on defined outcome ETFs, a deep dive into and how options are used in connection with defined outcome ETFs, talk about regulatory potential challenges and issues, and then also discuss what we think what we think we can look forward to in the future. My panel will consist of Nellie Nelson from Innovator, Charlie Champagne from Allianz, and Matt Kaufman from Calamos. I would like to have those 3 introduce themselves and provide their backgrounds, and then we'll get started into our Q&A discussion. Nellie, I'll start with you.
Thank you, Morrison. Good afternoon, everybody. As you heard Morrison refer to me, I do go by Nellie, last name being Nelson. I joked with these individuals as we prepped for this panel. It certainly isn't the most professional sounding nickname, but at this point, it's what I go by. It's how I sign my emails. And so I said, well, as you introduced me, just let's keep it casual, and I'll go by what I go by around the office. So nice to see everybody this afternoon. As Morrison mentioned, I am part of Innovator ETFs. I only joined Innovator in May of last year. Prior to that, I spent over 13 years at Invesco ETFs. And so coming into Innovator has been a breath of fresh air in the sense that we are solely focused on this idea of risk-based, options-based ETFs. And really having that sole focus, I think, is a benefit to you all, the end users. But I'll let the others introduce themselves. We'll get back to more about that in a minute.
So Matt Kaufman, please.
Thanks, Morrison. I'm Matt Kaufman. I'm the head of ETFs at Calamos. I've been in the ETF space for a little over 20 years, started off my career early days at PowerShare. So a little bit of similar framework to Invesco there for Nellie. After PowerShare sold to Invesco, I went to an actuarial consulting firm, which makes about as much sense saying that out loud today as it did going there back then. We were doing institutional hedging strategies on the balance sheets of large life insurance companies, building a lot of insurance products. And so we were able to be a part of that intellectual property development for defined outcome ETFs. Innovator was a client of mine back then. We built these types of outcome strategies and UITs and insurance products and ETFs. So excited to be here talking about it today. I've been at Calamos for about 2 years, building out the active ETF line. We built that series of 100% protected ETFs, and then have recently launched a Bitcoin strategy. So I'll pass it back over to you.
Charlie?
Thanks, Morrison. Good afternoon, everyone. My name is Charlie Champagne. I am the head of ETF strategy here at Allianz Investment Management. What I focus on here at Allianz is essentially product development, capital markets, and just the more holistic long-term strategy for the ETF business. I have been working in the ETF ecosystem for the better part of 15 years now. Previous to Allianz, I was at State Street Global Advisors working in the Spider ETF business. And I've been here working with defined outcome ETFs for the past 2.5 years.
Great. Let's start from I guess the beginning, and an introduction to option linked ETFs, and perhaps the history of defined outcome ETFs. Nellie, can you help us with that and speak in generalities about the importance of options as it relates to defined outcome strategies?
Yeah, absolutely. Thank you, Morrison. And the founding story is a fun one. Matt mentioned the PowerShares legacy here. So our two founders, Bruce Bond and John Southard, were the founders of PowerShares ETFs, which then sold to Invesco. So they do have a legacy, certainly, of innovation and being first to market in unique ways. John Southard was actually pitched this idea of a structured product, structuring an outcome, you might say, a number of years back, and thought, well, why can't we just put this inside of an ETF? And so I think that really kicked things off. In 2017, our firm was founded. In 2018, we were the first to launch the world's first defined outcome ETF. It's been a rocket ship of growth since. We're excited to be a part of it. We now have over 130 different defined outcome ETFs. We now are north of 22 billion in assets. We cover 6 different asset classes and different buffer levels. It really has exploded in use case. The idea, again, of this kind of structuring of outcomes is not new, but the newness is putting it inside of an ETF wrapper. And with that comes a lot of benefits. So we can talk about that more in a minute. But we really are, again, solely focused on this, the pioneer of the industry in this way, and really have that as our North Star as we continue to build out our ETF lineup and see continued growth in that way.
Great, Matt. Can you speak about, in general, what option-linked ETFs are, how they work, and perhaps the differences between option-linked ETFs and traditional ETFs?
Yeah, that makes a lot of sense. So to, I guess, back up, generally ETFs came out as passive vehicles. 1993, you had the S&P 500 ETF, SPY, come out. Shortly after, you had the Qs and the diamonds, is how you referred to them back then, all based off of market cap weighted indexes. And then you fast forward a few years, you started to see more smart beta type ETFs, things that were built on non-market cap weighted index. If we go toward where we are today, the first options-based ETF, I think, was around 2008. It was a simple buy right strategy. We didn't see much innovation from 2008 until the birth of the defined outcome ETF space. I remember going to some conferences, popular ETF conferences around 2015, 2016, and looking for the options-based ETFs. Like, okay, surely someone would have thought about this type of opportunity to deliver options type strategies into an ETF. I found one panel, and there were about 7 people in the room, and they were talking about that same buy right strategy from 2008. It's like, oh man, no one really has developed any innovation in this space yet. And so what we worked on back then was building out options inside of ETFs. So when you look into the options space, there's a few ways you can use options. You can leverage your exposure. You can provide income like that first buy right strategy, or you can do risk management like a lot of defined outcome or buffered ETFs are doing today. And so that space has grown tremendously. I'd say one of the biggest innovations that we saw take place in the buffered ETF space was because options have a finite life, they have an expiration date. Now we can actually deliver certainty to an investor, and you can tell them what they're in for. All the way up until those defined outcome ETFs were launched, your idea of investing was to invest in the market and hope for the best. Maybe you've got bonds for risk management. You're holding your stock market exposure, hoping it doesn't go down. Well, now you don't have to do it that way. You can actually know what your upside opportunity is, what your protection level is, and how many days you have to hold, what your outcome period is in order to get that. So options have really delivered a tremendous amount of flexibility. And, as Andrew was talking about, that structured product space uses optionality, uses OTC options to deliver that. Here, you can deliver that using exchange listed options. And we'll talk about flex options as well. But we really see the options markets in the ETF world exploding. It's a several $100 billion space. We have large asset managers like JP Morgan, BlackRock, all doing options type strategies. You have defined outcomes that are telling you the value of your sold call option, so you can know what you're in for before you actually invest a single dollar. So there's a tremendous amount of opportunity still at hand in the options-based space, but that's a 30-year overview in 90 seconds here.
Hey, Charlie, can you, and pivoting off of what Matt was discussing, Can you speak about the key benefits and risks associated with option-linked ETFs? And it may be worth talking about the development of flex options in terms of helping with deliver some of these benefits.
Yeah, absolutely. And just going back to what Matt said, we've really seen the popularity of options-based ETFs explode over the past 5 years, really since the 2020 rule change, 2019, 2020. And there are a lot of benefits to investors. Option strategies can be valuable in multiple ways. One is obviously to boost income to a portfolio. The other is to add, risk management to a portfolio. I think the biggest benefit is the ease of access to these markets without having to trade options, on your own. Really, you can buy a retail package product that has this risk mitigation feature embedded into it. As Matt had mentioned, these products are designed to absorb losses while also participating in upside capture of return streams up to a cap or a spread. But I mean, these are great products to bring down the overall risk profile in your portfolio, and they're great for advisors and investors that may have a lower risk tolerance, and someone that's nearing retirement that doesn't have the ability to take on a lot of equity risk in their portfolio. So these tools have a lot of benefits to the market and investors in general. As far as risks go, I think there are a lot of perceived risks around derivative-based ETFs and defined outcome ETFs just in general. From what I hear from clients and partners in the industry is, a lot of people associate options with taking bets or gambling to some extent. But what these are is they are risk reducers for your portfolio. We use these in a structure that has explicit guidelines as to what the investor can experience, assuming they hold it for the duration of the period. And the other thing, these products are deemed as complex products, which I think is counterintuitive to what they actually are when the product themselves are risk management tools. So they do have a stigma of risk or a misconception of risk, in my opinion. Another educational point that we speak to clients a lot about too is just the stability of the options market. And what we have to keep in mind is these options, these flex options, are backed by the OCC, the world's largest derivative clearing organization in the world, and they're labeled as a designated financial market utility, right? So there is a high degree of scrutiny, beyond what a lot of financial institutions may have with the OCC. And, a lot of risk management professionals believe the OCC has a similar default risk to that of treasuries. So, I mean, it is a very secure market in our opinion. And I think some of the risks and misconceptions aren't warranted.
Thanks so much, guys. At this point, let's dive a little bit deeper into defined outcome ETFs in particular. And let's take, for instance, a buffered ETF as an example, just so that we can speak to something specifically. I would ask Nelly, how does a defined outcome ETF work that way? Obviously, we understand that there are caps and there are limits on losses generally, but can you speak to how they work?
Yeah, happy to. Thank you, Morrison. So they really are quite simple. And this is where, to Charlie's comment, being dubbed complex products is a frustration, because for the vast majority of our ETF lineup, we have a few different variables here, a few different options of how you could play the space. Most of our ETFs only have about 4 positions total. They're solely options based. And so to walk it through one by one, it really is, first for our lineup, let's take our 15%, what we call our power buffer series. So we have about 22.3 billion in assets I mentioned. Of that, I think it's about 75%, 16 billion and change, is in this power buffer suite, this 15% buffer ETF suite. And what that means is, again, that you are protected against the first 15% of losses over the outcome period. So how do you do that? That's the question, Morrison. How do you do that? First, for us, that first layer is about purchasing a deep in the money call option. We usually strike that call around 1% of the S&P. So we're, again, buying a deep in the money call option to give us synthetic exposure to the upside of the S&P. And then we're going to say, put the buffer on. And so first we're going to sell a put option at 85%. That's at 15% level. And we're going to buy a put option at 100%. And so that spread of that 15% between 100 and 85 is our protection. So we bought the put at 100, sold at 85, and then that has a cost to it. You have to buy that protection. And so to, again, fund that cost, we then will sell a call on the upside. Now, the beauty of this strategy is that the upside cap will change each outcome period based upon market dynamics. And so the caps are, again, reliant upon things like interest rates and volatility, and we don't need to discuss that too much. What we have found is if you can talk to a client and say, listen, it really is just 4 options positions for the vast majority of our lineup. And in fact, the 100 buffers are 3 option positions. We can talk about that if you'd like. But it really is about, again, buying that deep of the money call and then selling a put at that buffer level, call it 85%, buying the put at 100 to have that protection across that first 15%, and then selling that call on the upside to fund that. And so what that comes out to then is just what you would expect. It's saying if the market is down, call it 10 over the life cycle of that ETF over that time frame, you're down 0. If the market's down 20 over that time frame, you're down just 5. It takes out that first 15% of losses. And again, your upside is 1-to-1, but to a cap. And so we talk to clients about that. You know, they find that trade-off to be pretty healthy, actually. Something like 75% of S&P returns are inside that cap. And so there's an element of safety and security. We talked about it a little bit already, where you have this known, defined outcome, extremely simplistic to see and get, and people seem to grasp that and really, really grab onto that. And so we've been, again, doing a lot of educational work over the last 5 years, but it really is quite simple. And to Charlie's point, we don't deem it as too complex. You can find our holdings online. Everything's transparent as well. So, but that's how it actually works in process, is that for the vast majority of our lineup, it's 4 option positions. It's straightforward. You can see what they own. And that's how we construct this outcome over the defined period of time that we set for the ETF itself.
And that's great. Nelly, thank you. We received a question that was asking if there's a cap on the upside and limited downside, why not just buy fixed income? They're thinking that may be far cheaper. There are ETFs that are structured that way, that are defined outcome like ETFs. But perhaps, Nelly, you can speak quickly as to why generally you use an options package versus fixed income securities.
Yeah, it's a great question, and one we see a lot about coming from clients. In fact, we have an ETF. The ticker symbol is BALT, B-A-L-T. We constructed that ETF to be what we call kind of a bond alternative, hence the ticker BALT, because we feel that fixed income actually has not delivered on its promise of diversification and, say, non-correlation that we've seen over the last 5-10 years. So you have, again, periods when bonds do work, but periods when they don't. And over the last 3 years, we've seen actually negative total returns. We've seen move in lockstep with the equity market. And so we have clients tell us, hey, can we get more certainty and diversification? We point them towards BALT, which is, again, this 20% buffer every quarter. You find it to be extremely safe. And so there's ways to construct these outcomes that, again, are going to be very advantageous to the end client from both a knowledge perspective, and then there's also the tax efficiency side. And so we talk to clients about, hey, if you are using bonds as defense, you should be aware of the tax implications. If you're using bonds for income, then we understand that and keep on doing that. But bonds for defense, you have tax implications because of the distributions. Our ETFs are designed to ideally not issue any distributions, and you only have a tax upon the sale of that ETF. And so there's an element too about controlling tax timing, certainty on the outcome, and that, again, that correlation has risen. The performance has been subpar for the ag that we see a lot of folks actually, to that exact question, moving from fixed income into buffers. And so we even have, I don't need to talk about this the entire time, Morrison, it's a very easy topic to jump onto. We even produced a white paper that we call Buffers Over Bonds, discussing why you want to consider one over the other based upon historical returns. And we're happy to share that after the fact. But we really do have a strong conviction that there's a way to use buffers instead of bonds to create the outcome that you desire.
Super helpful. Matt, we will want to, it's worth talking about how the defined outcome suite has evolved over time, and also to talk about some of the different types of defined outcome ETFs that are currently being sold.
Yeah, sure. So, the first ETFs that were built in the defined outcome space had about a 10% protection level on the S&P 500. That was about the best trade at the time based off the interest rate environment that we were in. During my time at Milliman, when we were working on this construct, interest rates were at 0. They were between 0 and 50 basis points. And so you could not really afford to provide principal protection on your money. If you're a follower of the insurance space or maybe structured products, you would have seen that capital protected notes and fixed indexed annuities, which deliver 100% protection, were basically in the grave. Nobody was really buying those back then. And it really forced the insurance space to move into what I would call is a risk sharing model. So rather than 100% protection, they would give you something less and say, okay, we can give you a 10% protection level or a 20% protection level. I see Allianz behind Charlie there, so I can pick on them a little bit. They had what's known as a RILA, structured annuity. Those are very popular in the insurance space today, where you get the upside of a market to a cap in the insurance wrapper. And those, it's about a $50-60 billion space. Last time I checked, might be larger today. Well, we were able to take that type of construct and move it into the ETF wrapper. So when you do that, you introduce a whole host of efficiencies. You know, there's tax efficiency, liquidity, transparency. There's transparency into the fees as well. You know, ours are 69 basis points. Well, as I went over to Calamos to build out the active ETF line, you know, what are happening to interest rates? They're going up, they're going higher, 2, 3, 4%. And so if you follow all the flows, people are now buying fixed index annuities again. The cover of Structured Retail Products magazine last January was capital protection back with a bang. You know, all these capital protected solutions are now, you know, back into favor. And so that is the area that we wanted to carve out at Calamos. You know, there's about 10 to 11 buffered ETF providers in the market today, all carving up that partial principal protected space. But as you move into the capital protected space, that was the area that, you know, we really felt like was ripe for opportunity now that the rate environment was a little bit higher. You know, the question that you had about fixed income, I agree with Nelly there. If you look at that low rate environment that we were in over the last 15, 16 years, it really drove a lot of the innovation to the equity markets. If you look at the growth of ETFs over the last 30 years, more than 90% of that growth came in during a zero rate environment where rates were remarkably low. So you think about all of the product innovation that came through that framework, all these products were coming under the idea that you couldn't get income or risk management from bonds. We saw that in 2022. We saw it in a low rate environment. And so now we have products that can deliver risk management and growth potential. So you can use buffer ETFs, you can use capital protected ETFs in order to generate the type of risk management and growth that you're looking for. So you think about a risk-free rate, maybe it's 4%. You know, as Nelly was saying, that ultimately derives the cap rate that you're going to be able to achieve. Well, now you can get multiples over the risk-free rate, but get a protection level that might equal or be better than your fixed income. So I think all this panel probably agrees that the cap rates and protection that you can get can be remarkably more stable and a lot of times better than what you would achieve from a bond. If I could get 20 more seconds, the tax efficiency is remarkable there as well. You know, all of those bonds, all those structured products, the annuities have expiration dates. You're going to pay ordinary income taxes when those products expire. If you move into a buffered or structured ETF, you're going to get all that growth tax deferred. And that's by way of flex options that are European style. So none of those options can get called away. And then if you've held for longer than 1 year, you pay long-term capital gains. So you have a remarkable tax efficiency, compounding that growth over time. You don't have to sell. Your money will not be returned to you. So you compound that cap rate year over year. Even if you hit a down year, you're going to be in a remarkably better spot than compounding an after-tax bond yield.
Hey, and Matt, while we're speaking about taxes, one of the questions that had come in was relating to whether these flex options are in-kindable and the impact on tax efficiency. You might as well touch on that.
Yeah, for sure. So a lot of folks will say, oh, I can go out to the market listed options market. I can do this ourselves. You know, not to be trite, but the answer is no, you really can't. And we use the flex options marketplace, which is an institutional market where we can build exchange listed products. And the flex markets really allow us to have a high degree of customization. So we can choose the underlying S&P 500, NASDAQ, emerging markets, Bitcoin in some cases, or in this case. And so we can build these that are European style options. We can choose the right strike prices that we need. We can choose equity options versus index options. So to make a long story short, we want to use equity options because those can grow tax deferred and the taxes are treated as capital. that are European style. Normally, equity options are American style in listed markets, so that won't work. And index options have worse tax treatment, but they're European style. So the flex market allows you to choose equity options that are European style. You marry those two things together, and now you can create a tax deferred experience that you really only can access through the ETF wrapper.
Great. Charlie, we want to, and Allianz provides a range of exposures. Can you talk about some of the benefits of defined outcome ETFs versus mutual funds or individual stocks or even other structures, structured products or index annuities? I'm assuming all these products have a place, and so just getting to the place where you think the defined outcome ETFs fit.
Yeah, absolutely, and you're right. These products do have a place throughout the ecosystem at some point. I spent the last 15 years in a passive ETF shop for the most part, and spoke quite often about the benefits of the ETF wrapper over the mutual fund. And we've seen the change of guard on assets going into mutual funds versus ETFs over the past 10, 12 years. But now I'm coming from a little bit of a different place, right? So here at Allianz, one of the largest insurance companies in the world, ETFs weren't really on the radar until these structures started to pop up, because these options-based products really fit well with a lot of the work we were doing on the insurance product side, particularly as Matt had mentioned with the RILAs and the fixed index annuity, very similarly structurally. So it just was a natural fit. And annuities have their benefits, but the ETF wrapper provides other benefits which complements the different suites of products, right? So for ETFs, the intraday liquidity and the flexibility there is critical. Obviously these ETFs can be bought and sold like any other stock on the exchange, whereas an annuity has a term. And those terms are typically longer in duration than the outcome periods of the ETFs, meaning, you might get a little bit more upside cap on an annuity, but you are holding that annuity for a longer period of time. And if you do need quick access to capital, an ETF is very easy to liquidate, whereas an annuity, you may be paying a surrender charge to access that capital. So there are benefits for the ETF wrapper versus the insurance product. They both fit very well in an advisor's playbook. So they're really they really complement each other well, I would say. And one thing I'd say too is from a business point of view, ETFs, it's a very low capital intensive business. And then from a issuance standpoint or an insurance product provider, you don't carry the counterparty risk of that insurer. So there are some nuances between the two businesses which are nice and can be attractive to different investors or different advisors.
And Charlie, to respond to some of the questions that have come in, can you help us? One of the questions relates to how you cope with cash flows and the outcomes that are contemplated. And let's start with a basic sort of buffered strategy. When cash comes in, how doesn't that throw off the outcomes that are being projected?
Yeah, so kind of like how Matt had spoken right before me, when we define, at each role, we define the outcome period and the basket of options that will be held in that ETF throughout the duration of that outcome period. And those are flex options. Those are customized options that we've built with the counterparty. So naturally, I'll actually hit up on another question I saw. So we do accept in-kind, create, and redeems on the options. So that is part of this business, and it does help tax efficiency. But when we do see cash creates, we have to equitize that cash. And what we'll do is we have a very robust trade desk. We trade about $1 trillion of options notional a year here at Allianz. So our traders are very well tuned into the street, and we send our trades and the parameters of the options package to our traders, and then they have those fills. So as the price appreciates or depreciates of the ETF and the underlying products, that will be reflected in the new options packages we have to buy with cash.
Great. Nellie, it's worth talking about. We've talked a lot about buffer ETFs. Can you mention and full protected products? Can you talk briefly about some of the floor, uncapped, accelerated, just to give a sense as to the capabilities of the structure, and to those things that you're focusing on at this point?
Yeah, thank you, Morrison. So you put it well. There's a lot of different ways to tackle this idea of defined outcomes inside the ETF wrapper, and you can do it in many different flavors. And so to your comment, Innovator offers a series of accelerated ETFs where you get 2x on the upside to a cap. Innovator offers a series of laddered products where you can have one ticker and it's a managed outcome under the hood. Innovator offers a series of income-based ETFs that utilize options to give you a defined income rate. Innovator offers a series of, again, 100% protection ETFs. And I do feel the need. Matt did a great job explaining the role, but we were first to market in July 23 with that. So there's a lot of legacy here of all these different ideas about how to skin the cat. The one that I want to spend the most time on actually is that floor concept, because we've seen that be the most growth in the last, call it 6 to 9 months. And that is the idea that instead of a buffer, you offer a floor. And the buffer is, again, protecting against that first XYZ% of losses. For our lineup, it's going to be 9% or 15 or 30 or even 20 for the quarterlies or 100. We have all these different buffer flavors, but the floor flips that on its head. And you are on the hook for the first percentage of losses until you hit that floor. At that floor, you are fully protected beyond that. And so our most popular managed floor ETF is a series of these, what we call 10% floors or 90% protection, where we have again, written the call package that we can, or excuse me, the options package where you are on the hook for that first XYZ% of losses, in this case, 10%, but fully protected beyond that. So that's where we've seen a lot of growth. Again, you can get creative. I know Allianz has a number of structures, and Charlie can speak to that as well. But for us, we have seen a massive amount of growth in this idea of combining the concept of a managed portfolio where we do multiple things for you, and then the idea of the floor concept. And so just to be abundantly clear for what I've referenced, we do not call this a defined outcome in this case, because we do not specify the exact cap. We do not specify an exact floor. We actually will tranche it and layer it in for you over time to help you then again achieve a blended outcome over that full time frame, over your full holding period, but it does not require you to say buy on a certain date and sell on a certain date. It gives you flexibility in the implementation side. So combining the flexibility of implementation with the idea of the floor concept has been extremely beneficial to us. And we've seen a lot of growth and development in that space as well. So that's where I would actually spend most of my comments when you ask me here. We have a number, again, of different flavors of defined outcome. I mentioned a bunch: accelerated income, different levels of buffers, 100% protections. We actually have the most in that space. But the floors are where we've seen a lot of growth, and we've seen a lot of development being done there. And we're excited to see where that goes in the future as well.
And Charlie, now I'll ask you just if there's anything to add on to what Nellie had said, in terms of satisfying various goals or, products that you all focus on, whether growth, income, protection, or even these blended or managed outcome strategies.
Yeah. So the way we kind of, looked at the product strategy for the past couple of years is really trying to develop products that are going to be useful in a lot of different scenarios, right? They all have very similar characteristics generally, but we want to look at, products that will do well if interest rates decline and volatility rises and vice versa. So we want to make sure that we have products that are going to transcend different, regimes of interest rates and volatility and markets. It's something that will always have a benefit to the investor. So similar to Innovator, we have our different flavors of buffer with cap, which is the 20%, the 5%, the 10%, and then we have a shorter duration product with a 10% buffer. We do have a 5% floor, very similar to what Nellie just spoke about, not on a quarterly basis, but a similar approach. And then recently, one question that has come up quite often from advisors and investors in general is they like the idea of protection and when it's useful, but to cap the upside, it's a little bit of a hurdle to get past and to get their head around. So, one structure that we started producing this year was our uncapped series, which utilizes a spread, or some will look at it as a hurdle rate. So, there is a a hurdle rate throughout the outcome period that once you achieve returns beyond that, you are uncapped for the rest of the remainder of the return stream, right? So this product doesn't necessarily have a cap. It has right around a 3% spread. So that's what the investor may overcome to get to a Delta 1 return stream. But these products are very attractive in years like 2024 and 2023, where the S&P is returning 20-odd%, right? We're not capping out that exposure. We're still providing a 15% downside protection. And it's just, and for long-term buy and hold type of strategies, I mean, the S&P is going to generally out-return the average. I mean, the average is what, 9.5%, 10% historically, but we don't really see that average return anymore, right? So we want to create a product and a structure that can overcome some of those sideways markets and low growth markets.
Super helpful. Matt, a couple questions for you. One of the questions that we received in the Q&A and from participants are what kind of returns we're talking about. And I imagine that answer is it really, really depends. And so if you can speak to that, that would be great. And then also for defined outcome products that start at a given point and then ultimately have an outcome period and then sort of reestablish themselves, what happens when an investor buys in the middle of the outcome period? Like what do you all do to help people understand what their outcomes may be?
Yeah, thanks, Morrison. Appreciate it. I think to get to the ultimate cap, you have to understand what derivatives or what derives that ultimate cap. And so from our perspective, what we're seeing, you've got a risk-free rate and you have dividend yield, and then you have some risk premium. So if you take it at its simplest form, you look at 100% protected type ETF, you're taking the risk-free rate, which is about 4% right now. Div yield from the S&P might be 1.5 or so, and then some risk premium. And so what you'll end up getting is about twice the 1-year risk-free rate. So you'll always be meaningfully above that risk-free rate. But if rates go higher, S&P cap right now might be around 8%, maybe towards 9% for NASDAQ, 9.5% to 10% for Russell. Emerging markets might get you a little higher. And then if you went to an asset like Bitcoin, we're seeing about a 12% upside cap on that because of the volatility. Again, that vol premium is helping you there. But one thing to consider, you don't lose the dividend. I think we all agree on this call. You're not losing the dividend yield. It's getting applied to your capital appreciation potential. And so when you think about accessing a defined outcome product, you want an index, an underlier that's going to achieve a good upside, but that a majority of that growth is going to come through capital appreciation. So, over the last several years, the international products, a lot of the return has come through dividends. We've started to see international movement start to take off a little more, have a little more capital appreciation. But, as you think about what makes up the cap rate, you've got interest rates, dividend yield, and then some risk premium. And then the cap rate goes up based off of, the amount that you take on from a risk perspective. So if you're thinking about buffers, then, the lower the buffer, the higher the cap rate. If you're thinking about floors, how much are you putting at risk? The greater the floor, then the higher the cap rate. So to give you examples, we're launching some floor products in a few days here tied to Bitcoin. So now you can have Bitcoin exposure with a safety net. You can put that net at 0% or at 10% at risk. We're seeing cap rates around 30% for that, or 20% at risk, which we'll see about a 50 to 55% upside cap range. So depending on how you design your protection, depends on what that cap rate ultimately spits out. I think the conclusion I'm drawing from this is there's a whole host of opportunities for people to manage their risk and get upside participation. And so seeing exactly what each product offers, what the trade-offs are, and finding what suits you the best. If you look 9 years ago, there was only a couple of options in the market. Now you have a host of a range of options that may be best suited for you.
And one thing we wanted to cover, your target audience in terms of investors and use cases, I would ask each of you to just take a couple minutes and talk about that in general. Clearly, there's so many variations of these products that there's a wide span of folks who they may be appropriate for. But I guess I'd start with Nelly and then ask you guys to just take a couple minutes because we have a limited time.
Yeah, thank you, Morrison. So target audience, it's a bit of a trick question, and folks might smile when I say they're good for anybody, right? Anybody can use these products, but I mean that sincerely. The obvious answer is that most often the entry point is a pre-retiree or retiree. It's somebody that has the need for risk mitigation because they cannot afford to have a massive drawback before their decumulation phase of their investment portfolio. And so, you look at the stats, I'm sure Matt and Charlie have similar stats, but something like 3/4 of all wealth in the US is currently held by pre-retirees or retirees. You see the massive need in that sense of you cannot afford to stomach, say, a 20% drawdown in the middle of, again, a decumulation phase. And so the buffer idea, the concept of defined outcome and safety net makes a lot of sense. But what we've done is actually begun to coach clients to think about them outside of that pre-retiree and retiree and put them into buckets of asset class needs. So if you think about kind of what's my cash alternative, and that's Matt's comment, that's our 100% protection lineup that we're going to have, again, full downside protection. Upside is going to be about 2x that 1-year risk-free rate. So that's going to be kind of your cash bucket. What's my fixed income bucket? How can I outperform in that realm? And that's going to be that BALT idea we talked about briefly, that 20% quarterly buffer. Then how can I actually get more growth? Is there a way to do hedged growth? And we have some uncapped ideas also that Charlie mentioned. And so being able to coach clients across that spectrum shows that you don't have to be, again, a 55, 65-year-old individual looking to, again, mitigate your drawdown. You can actually implement these into, say, a 35-year-old's portfolio in the right fashion. We're not again, coaching clients to slot in a buffer ETF instead of, say, a core equity holding across their entire book. But we are saying that there can be value add when you swap it out instead for that right asset class replacement. So that's where I would go with that, to say majority is going to be pre-retiree or retiree, but we have actually seen continued growth. And that's where that managed floor concept comes in, because it's not capped. It's saying, okay, it's a way to get that controlled growth in a portfolio, still provides protection and still adds value to a young client's portfolio, but isn't going to have that hard defined outcome cap in that way. So that's where I'd start. I don't want to steal the thunder of Charlie and Matt, but that's where I begin for our response to who uses our ETFs and where do we see growth at from our clientele.
And Charlie?
Yeah, you covered it perfectly. So that was spot on. And that's how we look at it too. That's the primary driver of these products. As we, that's historically how we've looked at it. And obviously coming from an insurance firm, we're very familiar with that. But I would add a couple of things that, rather than just looking at pre-retirees and retirees, we found on survey data that even younger generations are becoming less risk adverse or more risk adverse than middle generations, right? So that's when Nelly goes back to the 35-year-olds. As long as they're implemented into the portfolio in the right way, these can be very impactful tools to the portfolio to mitigate risk, to even replace other asset classes. One thing that we look at is asset classes and what low vol ETFs have done for the past 12 years. I mean, if you look at the risk statistics versus defined outcome, it's comparable, if not better. So it's just another tool for an advisor's tool chest to deploy these type of products where they see fit, when they have gaps, or if they want to take protection in certain areas.
Matt?
Yeah, I think to continue on the retiree statement, we're seeing the largest number of retirees enter the market that we've ever seen before, 11,000 every single day. If you look back to when the Social Security Act was passed, about 1 in 16 people were of retirement age. We're getting to the point where that's going to be about 1 in 4. Nearly 1 in 4 investors are going to be of retirement age. And so it's a massive swath of people that all need risk management. They no longer have this behavioral problem of just needing to ride out the market waves. But now as they enter retirement and start to use their portfolio to provide for themselves when they no longer work, you suddenly have a mathematical problem that you need to solve, where volatility combines with those withdrawals in a very negative way. You got sequence of returns risk. And so, a lot of these products, the buffered strategies, can really help solve for that. The invention of the 100% protection products really opened the door and opened other parts of the portfolio. So where before you would think of your cash as a safe money alternative, a CD, maybe a money market fund. Well, now we were saying, you can get twice the upside of the risk-free rate, but in a risk-free way And so we're seeing people really open up the whole portfolio to apply the protection levels that they're looking for. And I think it, summarizes just by the way that financial advisors have historically tried to meet a risk tolerance. The way that typically goes is you'll meet with your client, fill out a survey, and then it lands on a risk tolerance, conservative, moderate, or aggressive. And the historical way to achieve that would have been to look back over the last 20, 30 years and say, okay, what mix of stocks and bonds would have given you an average volatility that you are looking for? Maybe your conservative is a 10 vol, aggressive, maybe 20, 30 vol, something like that. Well, what happens is that conservative portfolio over shorter time periods becomes a lot more volatile. A lot of those asset classes become highly correlated and you all fall together. Now you don't have to do it that way. You can meet with your client, determine what volatility level suits them, and you can nail it. You can say in 12 months or 2 years, or if you're in a RILA, 3 years, 5 years, we're going to meet again, and I'm going to tell you exactly the payoff profile that you're in for. We're going to take on the amount of downside risk that you choose, and then I'll tell you in 12 months exactly, we're going to meet exactly the objective that we decided together. So we're seeing a lot of advisors use defined outcome ETFs and other types of payoff profiles to just really meet and nail the risk tolerances, that they're hoping to deliver on. They had to guess before and hope for the best. You don't have to do that anymore. And if there's one final point, we've got the 100% products that we've launched. The one that's a little more, loose would be our CanQ product, CANQ. So if you can understand a hard protection level or a hard floor, you can understand a bond floor. So now that rates have risen up to 4 or 5%, and we've seen start to come back down a little bit, we've built a product that has an actively managed bond floor, and then we've got about an 80% upside capture to the Qs. So we've outperformed the Qs over time on some, the product's been around a year. So we've done better than I expected even on as far as Qs performance, but having an active bond floor in this type of rate environment, I think can make a lot of sense. So I'll pass it back to you.
Sure, and we'll briefly talk about some challenges and regulatory, let's say, hurdles that you all are facing. Charlie had talked about this complex product designation, which is in many cases probably a misdesignation because we're talking about products that seem to be regulating or reducing risk as opposed to magnifying risk. Nellie, can you briefly talk about, I would ask you to speak about liquidity and this complex product designation and ultimately what you all are doing to educate the marketplace to help people understand that these products may be options based, but also risk regulators?
Yeah, great question, Morrison. Thank you. I would just go back to the fact that at the end of the day, it's all about education. It's all about coaching our clients to understand how these actually work, and then pulling the curtain back and saying, listen, the ETF wrapper is beautifully transparent. And so we would disagree with the complex product designation. We feel like you do, Morrison, that these are risk reducers, risk regulators, if you will. They enhance returns because of their, again, risk managed outcome. That Sharpe ratio can be enhanced with these ideas. So certainly not complex in our mind, but it's about education. And so walking a client through and saying, listen, for this buffer ETF, it's 4 positions or it's 3 positions. That's where we begin. And so most of our clients are actually right now registered investment advisors, RIAs. And so we've seen a lot of that kind of hand-to-hand combat being done on the ground, where our sales folks go out every day and do our best to educate clients on how these operate, why you want to use them, and when you want to use them. So for us, it's about playing the hand you're dealt. I don't think we're going to be, again, pleased if these maintain their complex product status. But again, over the time, we really feel that education does trump all. As far as liquidity goes, we are playing in the most liquid options market in the world with SPY-based options. I believe it was Charlie that mentioned the volume they trade. It really does show, again, the growth in the space, because we talk about liquidity for the ETF wrapper. For those that know the ETF, it's all about the underlying liquidity in the ETF itself, not the actual on-screen liquidity. So what I mean by that is to say, if the ETF itself, say ticker PJAN, we call it, if that trades, say, 20 times a day, now it does more than that, of course, but let's say it does 20 times a day, that's actually not as important as what the holdings of PJAN will trade each day, because it's about market makers and authorized participants. They care about the underlying liquidity as they create or redeem shares. And so for the options market, it's important to utilize the most liquid, the deepest options market, because in reality, it's about that implied, we call it the implied liquidity, and not that on-screen ticker level liquidity. And so that's where we coach clients on that every day. We produce a number of pieces that illustrate the magnitude that we can, again, trade without any impact to the market. We produce pieces showing, again, the volume that SPY options face every day. And so really feel like the asset classes that we've chosen, whether that is SPY, S&P, or the Qs, the Russell 2000, we're choosing these asset classes that have sufficient liquidity under the hood to, again, handle any large trade needed without any concern from the client on poor pricing or poor execution. So that's maybe a deeper answer than you care to know. But again, for us, if I had to summarize that response, it's about education to the client, one-on-one, hand-to-hand education to the client, and then coaching them through the fact that we are only doing this in the liquid and deep markets that can afford to handle that, as opposed to, say, the esoteric asset classes that you might have issues with over the long term.
And Charlie, can you speak briefly to how these defined outcome ETFs from a tax perspective compared to other ETFs? You know, are there major differences? Do they function essentially the same way? Just wanting to clarify tax-related issues.
Sure. I mean, there are nuances, right? But it gets really deep into the weeds, and we don't really want to go in there. But from an investor standpoint, these are as efficient, or should be as efficient as, you know, a pure beta or an indexed ETF. We do work through the primary market on create redeems, both in kind. And, you know, it's a portfolio management strategy to maintain the taxes, or so that there is no distributions needed at the end of the year. But it's not all that different than just a pure beta ETF as far as how we manage the product.
And Charlie, I'll stick with you. And this is, we're running low on time. Just final thoughts, future outlook, what you're excited about regarding the space.
Yeah, you know, I'm really excited about where the space is moving. And, you know, we look at the next 3 to 5 years, and we see continued growth. That's what we project. You know, and we focus based off that, right? So we just brought a couple of fund-to-fund products to market in January. We're going to continue to make that suite of products more robust. We think there's a lot of value there. That value is in the products. It's in new markets. It's in new approvals with different platforms. And then going beyond that, we're looking at other products of shorter durations. We're really listening to the feedback we're receiving from our partners in the ecosystem, whether it's different channels, whether it's different advisors or RIAs. You know, we're really listening to what they are looking for from a product standpoint, and what could be next to see a lot of movement in some of these channels that don't approve or don't use or seldomly use buffered ETFs now. So I think the outlook for the entire ecosystem of defined outcome ETFs is extremely positive, and I'm looking forward to the next 3 to 5 years.
And Matt, in a couple minutes, your views on future outlook, what you're excited about.
Yeah, appreciate it. If you look all over the world, this is how most families invest their money, and they do it through the bank channel. A lot of them buy structured products. It's hundreds of billions of dollars a year space all over the world. In the United States, most families use a financial advisor, and they simply haven't had the tools in order to be able to invest in a structured way. And so from my perspective, we are now delivering through the financial advisory community, 400,000 of them around the US, the ability to now do this in a structured way, so you can provide risk and return in a way that works for everybody. So to me, we are in very early innings of this. I think it's a multi-trillion-dollar market over the next 20 years or so. I think there's going to be massive amounts of growth. And I do think a lot of families, institutions, you know, high net worth individuals, they're going to look at the defined outcome concept as a way to look first toward investing, and not just the way of beta.
Nelly, I'll ask you the same question. What are you excited about? What do you think the future holds?
Yeah, I'll actually begin to dovetail off Matt's comment. He mentioned institutions. Just this year, we had, or I should say just last year now, the UConn Endowment Fund, the University of Connecticut, began to put on for the first time ever a buffer position, as opposed to utilizing a hedge fund. But we think that is maybe just the beginning, the first crack in the wall to where you have institutional caliber asset managers looking to use buffers and realizing the value of buffers as opposed to, say, a high price hedge fund. So that would be one area that we really think that this was kind of the first time we've actually seen it utilized, right? Where we've heard a lot of talk in the past, but really been put money where their mouth is and utilize buffers in the institutional space was exciting for us. And we think that's the beginning. Beyond that, we have seen a lot of growth. If you were to say kind of three areas of our market, of our lineup, we would say the floors, these quarterlies, and the hundreds. And that's kind of our internal way of designation, but that's where we see a lot of growth is in, again, the quarterly outcome period, the more frequent reset. So every 3 months, the ETF is resetting its defined outcome parameters. We find that to be very exciting for clients that, again, want to have that flexibility of implementation, but yet keep that definition of knowing what their outcomes are going to be. And that quarterly reset period is growth. And lastly, I'll say, Matt mentioned Bitcoin. We're excited too. We've actually filed and we'll be launching shortly a floor Bitcoin product as well. Respectfully, we'll be doing it differently. We're excited to see, again, that's the beauty of the ETF ecosystem, is that there's other opportunities to skin the cat, but we're going to have an uncapped approach to our ETF. And we don't want to take, again, the total risk off the table. We want to allow folks to access the Bitcoin in an uncapped fashion while still providing the floor. So we're going to kind of combine these elements of, again, the quarterlies, the floors, and the 100% buffers as a growth engine for us, and where we see a lot of assets going outside the institutional space as well.
Guys, this was super helpful. I know that each of you would be willing to entertain any sort of questions or calls individually, so that's open for the audience. We also would be happy to come back and speak about this in greater detail or specifically. There were a couple of questions that were very specific, and I think that one directed at Matt that Matt can respond to directly himself. There was a question too as to, is there opportunity for perhaps with inverse funds with floors and ceilings or for hedging? And I'm assuming based on what you're all saying is like probably a lot is possible going forward, and that's the exciting thing about this space. It's growing every day. New assets are being subjected to this process of defining risk or providing income or expanding the potential returns, and it's a very exciting space. We would say thank you so much for sharing the time with you all. If I could get one last thought from each of you in terms of your perspective on what we've just talked about. We have just a couple minutes. I would love that. So we'll start with Charlie.
Yeah, my final thought would be exactly what we did here is what we need to do, and that's education and continue to educate advisors and the investing public, generally speaking, about these products and getting some of those misconceptions kind of put aside, right? And talking about the true benefits of these products and how they work. And, we have these conversations almost daily, and we love to have them. If advisors want to get under the hood and actually look at the option structures, happy to do that. So just the educational component is excellent, and this venue is great for that.
Matt?
Yeah, I would just reiterate the future's bright. We continue to have good turnouts on webinars like these, and so appreciate you spending the time with us. NYSE, appreciate you allowing us to join, so I'll leave it at that.
Nelly?
Same thing. The future is certainly bright. We've seen exponential growth. The number of products, the assets, the opportunity is still absolutely huge. So we're excited to be in the space and pioneers of it. We'll see where it goes in the next 5 years.
Thank you very much, everyone, for participating. It's our understanding that this has been recorded and will be available to those who want to listen to it again in the future. And as I said, each of us would be happy to entertain any questions or thoughts separately after the presentation.